Good afternoon, everyone, and thank you for joining us on today's quarterly MLP webinar to discuss the state of the MLP market and current MLP valuations. My name is Will Hershey of Yorkville Capital Management, and I will be moderating today's call. Joining me today from Yorkville will be Darren Sharinga, Jim Hugg, and Len Edelstein. If you have any questions during the course of the prepared presentation, please feel free to type them into the text box in the bottom right of your screen. We will hold a question and answer session at the end of the call, and we'll do our best to answer everyone's question. With that, I will turn the call over to Darren for his prepared remarks.
Thank you, Will. Before I begin with my prepared remarks, I'd like to take a moment to welcome Mike Borges, who recently joined Yorkville's research team. He's a Columbia Business School graduate. If you happen to speak to Mike over the next couple of weeks or months, please make him feel welcome. With that, I'd like to begin with the MLP quarterly review. The first slide that we're looking at here is MLPs enter bear market territory. From their peak in August of 2014, so over the past year, MLPs are down 26.7%. Drops of greater than 20% are what is commonly known as a bear market territory. So the question is, why is this good for investors, on one hand, who are establishing new positions in MLPs, and why should existing investors not be concerned with the drop in price of MLPs? Over the course of this conference call, we'll address the two questions: why a bear market and how a bear market could possibly be good for investors. As we look at the asset class performance year to date, and the numbers we're looking at here are as of 7/31/2015, you can see that all of your income-producing equities are down for the year. You look at REITs, they're down 1% on the year. Utilities are down over 5%. Clearly, MLPs are down worse. If you look at the MLP universe, it's down 11.2%. When we look at this and compare ourselves to REITs and utilities, ourselves being the MLP asset class, we see clearly that there's more than declining oil pressure that are putting pressure on income-producing securities. There's also an element of interest rate risk that is being introduced. So REITs are down, utilities are down, and MLPs with the added pressure of oil are down even more so on the year. Looking at an asset class comparison again, these are alternative equities that produce income. As we look at yields as of 7/31/2015, overall in the MLP asset class, you're yielding 6.4% through the end of July. The yield on REITs and utilities are both under 4%. On a historical basis, this would make both the REIT and utility asset class relatively more expensive and trading below their historical averages, whereas MLPs, one of the reasons why bear market territory is good for MLPs, are trading above their historical averages when we look at yields across the asset class. The other interesting comparison on this graph is when you compare the MLP universe with commodity MLPs, you see a spread of over 500 basis points. Historically, the spread between MLPs and commodity MLPs has been approximately 250 basis points. So if you're looking at relative value across the asset class of MLPs, where commodity MLPs are trading currently, they are the least expensive of the asset class at this point. The other point is MLPs relative to REITs and utilities and relative for investors looking for income on a global basis, the 6.4% yield on the asset class of 7/31, and we'll touch on more recent numbers in a little bit, is actually higher. Yield will actually start putting a floor underneath MLPs, because where else are investors going to be able to find this high-quality income that's yielding over 6%? The lessons that we learned, that Yorkville learned as a firm in 2008, really is exemplified in these two scores that we created, the stability score and the growth score. When we look back at 2008 in our portfolio, 100% of the names in our portfolio in one of the worst economic environments in the commodity price environment, oil went from 140 into the 30s. 100% of the names maintained or increased distributions. We wanted to give investors two scores that would help them look at what we believe are the thesis underpinning MLPs, the quality of the distributions and the quantity. So how good are the distributions and how much is the overall growth rate of distributions? So the Yorkville Stability Score of 8.6 is the scale that goes from 0 to 10, and 10 means that there were no distribution cuts across the asset class, or 100% of all MLPs maintained or increased their distribution. Conversely, a score of 0 means that 100% cut their distribution. So a score of 8.6 means that 86% of all MLPs maintained or increased their distributions in the most recent quarter. So what is that representative of across the asset classes is relatively high quality. The fundamentals are largely unaffected, as we've been telling investors, and we saw in 2008 as well by the pullback in oil, and in 2008 also by a global recession. The quantity, how much growth is there, if you look at the growth score on the overall asset class, is 2.4%. The growth rate, and that's why we said fundamentals remain relatively strong or sound, the growth rate at 2.4% is below historical average growth rates in the most recent quarter, and we'll drill down where what's causing the below average growth rates across the asset class. We looked at infrastructure MLPs, and this is part of our the Yorkville MLP universe indices, which are 13 indexes that cover the entire MLP universe, and this is all infrastructure MLPs. You look here, the stability score across infrastructure MLPs is 10, meaning that there were no cuts across infrastructure MLPs in the most recent quarter. And look at the growth rate of infrastructure MLPs. It's 11.5%, which is well above historical growth rates for the asset class, in this segment of the asset class. This is a big part of the story that we've been telling investors in the investment thesis. It's not a story, it's the investment thesis underpinning MLPs. The infrastructure model is not an energy business model. Traditional energy business model is quite simply production multiplied by the price of the commodity equals revenue. Well, if you have commodity prices going down and production being held flat, you'd expect revenues to decline as a result, cash flows to decline as a result, profits to decline. The MLP business model is a leasing business model. So what you're doing is leasing capacity on your pipelines with long-term contracts that are largely unaffected by volumetric risk or commodity risk. And so we'd expect that the stability and growth would be maintained across commodity cycles as well as economic cycles. So again, looking at infrastructure MLPs, you see high quality and high growth, even with oil prices now dipping back into the 40s. The next slide looks at the sector fundamentals. Again, the growth and stability are our two scores. Part of our universe indices, we've created 10 sectors that look at MLPs based on their fundamental business drivers. So let's focus on the stability score first. You can see that there's 3 sectors. Well, let me look at it in the inverse way. 7 out of 10 sectors have maintained 100% of the partnerships within these sectors have maintained or increased their distributions in the most recent quarter. 3 sectors is where 100% of the distribution cuts have come from. The worst sector is a stability score of 0, is on the bottom, exploration and production. That means 100% of all E&P partnerships cut their distributions in the most recent quarter. Now, the magnitude of the cut was 48%, so they were cut in half. That is what is driving down the overall growth rate in the MLP sector. Exploration and production companies, again, although they're hedged, it's still volume multiplied by price of commodity equals your revenue. MLPs that are structured as E&Ps generally have a hedge book, so they're not picking up short-term commodity prices, but they are going to pick up longer-term commodity prices. So what we witness here right now in our current drawdown really parallels what we saw in 08. 08, any cuts that came within the asset class, again, during the Great Recession and the financial crisis, came within a couple of sectors. The majority of the asset class, again, shows the stability and the growth that we're describing across commodity cycles or economic cycles, again, because it's a different business model. It's not an energy business model. So why invest now? Why is MLPs entering into a bear market territory good for investors who are thinking about entering the market, and why should you not be concerned if you're an existing investor in the asset class that the sky is not falling? Well, it all comes down to fundamentals. So for new investors and for existing investors, MLPs' current yields are trading above historical averages. Right now, we're looking at the yields here and why there's a different number. These are going straight through until August the 13th. The MLP yield is now up to 7.2%. This is looking at the historical basis over the past 5 years of 6.2%. MLPs are trading at a discount to where they have been historically. Ultimately, and we've had a number of conversations and with foreign investors as well, the yield on MLPs is becoming extremely attractive as an entry point. Where else can investors on a global basis find this type of income? And the question then really becomes, how safe is the income? Well, we just demonstrated on the earlier slide, 7 out of 10 sectors have not cut distributions at all and are growing their overall distributions. So arguably, if you've avoided the 3 sectors, your income has been stable and growing straight through the commodity pullback. So yield becomes supportive of the asset class at current level, 7.2%. And MLPs are trading at a discount to historical valuation levels. Number 2, we look at MLP yields versus 10-year treasuries as one of the metrics we use to value yields on a relative basis. Obviously, investors have choices of where they can put their money. And right now, MLPs are yielding at a spread. 10-year treasuries 2.2%, again, as of August 13. MLPs 7.2%. This is over a 500 basis point spread or 5% spread of income you're picking up by investing in MLPs versus treasuries. When MLPs have traded at a 500 basis point or above spread or a 5% spread relative to treasuries, 100% of the time over the next 12 months, returns have been positive on a historical basis. And that's an incredible fact. When MLPs have traded at a spread of over 500 basis points, 100% of the time historically, returns have been positive over the next 12 months. This next chart is really busy. I'm going to try to simplify it. Looking at, again, it's comparing spreads of MLPs relative to treasuries, so that 500 basis point spread. So if you look at the bottom line, where it goes from 0 to 100 to 700 plus, 500 to 600, is the current spread that MLPs are trading at relative to U.S. treasuries. And the triangle, the gold triangle above it, is what the returns have been on average over the next 12 months when MLPs have traded at these spreads. So the returns have been extremely high on a historical basis, greater than 30% over the next 12 months. Not only have they been positive, but they've been extremely high. Why is that? If you simplify this chart, to the right of the chart, 700 basis points plus, MLPs are cheaper. Yields are higher. They're trading at a discount to where they have on a historical basis. When you are able to buy an asset of high quality, the lower the price you pay, the better. And it determines your returns that you will earn on the asset class. So on the right side of the chart, spreads of 500 to 700, MLPs have traded here very seldom. So the opportunity, the window that we have right now is only open to investors in under 10% of the time at spreads of 500 or above. The majority of the time, MLPs trade between 100 to 500 basis points, really 100 to 400 basis point spreads to treasuries. So when we see spreads and valuations that are as wide as they are right now, MLPs are cheap on a historical basis. Investors seldom have a window of opportunity to move into the asset class. And when they're able to buy at these elevated spreads, the returns have been better. Conversely, on the other end of the chart, when MLPs are more expensive, spreads are compressed relative to treasuries, investors have experienced lower returns on the next 12 months. So in summary of those three charts, MLPs right now, why is it a bear market territory good for investors? If you haven't entered the asset class, this is an opportunity to get in at valuation levels rarely seen in the history of MLPs. And when investors have entered positions at these levels, they've been rewarded with outsized returns on the asset class due to valuations. All of these yield comparisons would be moot unless the fundamentals were there. The investment thesis, again, underpinning MLPs is distribution, and not only the quality of distribution, meaning the stability of distribution, but the growth of distribution. This chart, I know we've looked at it before. I need to bring it back up again because it's so important. I think it's the best representation of the difference in the MLP business model when we look at earnings or cash flow relative to the energy business model. The line going through the graph, the squiggly line, is the price of oil over time. And you can see in 08 through 07 through 08, that's when oil dropped from 140 into the $30 range. And again now in 2014 into 2015, we've seen it go from under 100 now into the $40 range. Again, MLP earnings, which are the green lines, between 08 and 09 were basically flat. They dipped slightly. It was a 9% decline. Look what happened with energy earnings, the silver line. Energy earnings were crushed. And that is, again, just another representation of the quality of the overall cash flow that MLPs are producing that is unaffected by the price of oil or by commodity cycles. Clearly, right now, investors are believing that MLPs will be affected by the price of oil. We've seen the pullback, but that hasn't translated into fundamental underperformance, nor do we believe it will, nor have we seen it given the analysis that we've presented today. The Yorkville Core Income Strategy, we were recently awarded or recognized by P&I magazine as the 4th best performing manager in the entire United States out of all equity managers over the past 5 years. So investors, in order to achieve better 5-year returns, there would have only been 3 places they could have gone out of 1,700 managers to deliver better returns. So we're really proud of our investment process and our philosophy to investing in MLPs. Clearly, it's worked on a historical basis, and we're going to talk on how it's worked recently for investors and what differentiates Yorkville from our peers, or really what we do more specifically. So MLP Core Income Strategy, delivering fundamental alpha, and what we have control over as analysts and investors is our ability to research the companies and get a really good feeling for what the distributable cash flow looks like. What do we have almost no control over? What happens with commodity prices and what happens with the price of the underlying partnership. But if we're right on fundamentals, then we're confident over the long term the performance of the investment will bear out. We look at and we present the stability score and the growth score. We talked about it on the overall asset class, and then we like to compare it to our strategy. Ultimately, what this is, it's our report card is the way we like to look at it on a quarterly basis. Are we delivering on our investment objectives, which is to deliver a best-of-breed MLP experience across our entire portfolio? And we measure best-of-breed MLP experience by stability, no cuts across the portfolio, and consistent growth, again, across commodity cycles as well as market cycles or interest rate cycles for that matter. So the stability score, how did we rate? There were no cuts across our portfolio in the most recent quarter, nor have there been since the quarter's ended. This is a continuation of our ongoing record of never having a distribution cut in the core income strategy since and including the downturn of 2008 and 2009. And it's a record we will fight to preserve for our investors. The second measurement of our fundamental alpha, what is our growth score? The growth score of distributions across our portfolio was over 20%. Again, far above the growth rate of the overall asset class. This is from, again, going back to a report card analogy. The report card shows that Yorkville's been able to deliver significant market-beating distribution growth, and more importantly, just deliver distribution growth in the commodity environment. Why is that? Because, again, it's a different business model. It's a leasing business model, not an energy business model. The core income strategy, current yields, our investment thesis is, in the way we invest in MLPs, is we look at them as a total return investment. The thesis underpinning MLPs is high-quality distribution growth is more important than yield in determining the total return of the asset class over time. If you look at Yorkville and try to picture us and where we fit in, we're the growth managers of MLP investing. So when you look at a growth manager here for MLPs, the MLP universe as of 6/30 was yielding 6.4%. The MLP core income strategy was yielding 5.4%. So there's a trade-off for high-quality growth. You give up a little bit of yield, but you pick up, hopefully, on total return over an investment cycle. So let's see how we compare on the distribution growth side. Year over year, again, distribution growth, these numbers are of 6/30 through the end of the second quarter. The MLP universe is showing 2.1%. That's a skewed number because of the three sectors that have cut, and the biggest coming from exploration and production. So we looked at the infrastructure. The majority of our portfolio is positioned in infrastructure names. Over 90% of the portfolio is in infrastructure. 99% of the portfolio currently is fee-based, meaning we should be better insulated and are positioned to withstand, again, the downturn in commodities, which our distribution growth rate has demonstrated. So at 21% growth rates, it's 1.5% greater than infrastructure MLPs. So our ability as stock pickers to identify the best-of-breed partnerships that will deliver this fundamental alpha, higher quality, faster growing, should over time produce better total returns. If you look at the really a great way, this next slide shows total return potential. It's quite simple. It's a back-of-the-envelope calculation of what the total return potential is. You take current yield plus your distribution growth, add them together, and you get a good indication of what the total return potential of that investment is. So if we look at the MLP universe, it's yielding was yielding 6.4% as of 6/30, depressed growth rates of 2.1%. So the asset class as a whole has 8.5% total return potential currently. There is one thing that I'd like to point out. If your distribution growth rate is low, the majority of your returns come from income. 6.4% of 8.5% of your returns are coming from income. Conversely, when you look at the Yorkville MLP core income strategy that's yielding 5.4%, you're adding over 20%, 21% growth rate to it. The total returns come into the mid-20s. Majority of your return here, or the return potential of the strategy, is coming from distribution growth, which is exactly where you want to be, because as Jim Hugg has said for years, distribution growth is what differentiates MLPs from other fixed income investments or from other alternative income producing equities. They're just growing faster. And when we look at the macroeconomic backdrop today of the unconventional shale plays and the U.S. energy revolution, we've never seen a better backdrop, in addition to just the magnitude of oil we're producing right now. We're producing oil at 9.4 million barrels per day, which is 40-year highs. So finally, with distribution growth, it's where you want to be. It offers investors protection in rising interest rates. So again, our thesis has always been it's a total return strategy. You want to look for distribution growth because that's the holy grail to MLP investing in high-quality distribution growth. So finally, this next slide looks at the returns of the MLP core income strategy. So as Yorkville's focused on what we have control over, fundamental alpha, as analysts and investors, translating into price return or total return alpha. So in English, is it producing superior returns? If you look at the quarter, excuse me, we were down 5.4%. MLPs in general down 6.1%. So we're both down. We're down slightly better. Looking at the year, the center group of bar charts year to date, or bars, year to date, the MLP index was down 11%. Our MLP core income strategy was down roughly 2%, delivering alpha of 9%. And when you look at our 3-year numbers here on an annualized basis, MLPs have produced 8%, we've produced 21%. So on a per annum basis, by focusing on fundamental alpha, again, what we have control over as research analysts and ultimately as investors, is producing 13% premium over just beta exposure to MLPs. So our quest for fundamental alpha is translating into superior performance overall in the asset for our MLP core income strategy. The next slide just looks at performance that goes back to the inception of the strategy, which is really incredible. We're into our 14th year here. We'll be wrapping up our 14th year at the end of this year, and it's delivered almost 15% per annum over a 14-year period. So when we look at MLPs as an asset class and judged by what we do, not by what we say, everyone in the firm is 100% invested in MLPs because we believe in it, number one, but more importantly is we see MLPs as a wealth-generating asset class for the foreseeable future. So we can't find a better investment for ourselves or for our investors when we look around the globe. So that wraps up my formal remarks and Yorkville's formal remarks at this stage. The Yorkville core income strategy is the blue chip growth investment in U.S. energy infrastructure investing. If you haven't looked at our website, please do. There's a lot of great information on the MLP asset classes. Our core competency is we're a research-driven shop. We like to publish a lot of information. We want to educate investors on the asset class, and we're always available to speak. So I'm going to turn it over to Will so we can answer your questions, and Jim and Len will join me in the Q&A.
Yeah, absolutely, Darren. Thank you for the very informative presentation. And as Darren mentioned, now we will begin the question and answer portion of this call. As a reminder, if you have any questions that you'd like addressed, please type them into the bottom right corner of your screen. And as a matter of fact, it looks like some of you have already utilized that tool, and we have questions in the queue. So with that, why don't we kick it off here? Len, let's give Darren a break for this first question. How safe is the income for MLPs given the current commodity price environment, especially if we remain here for a significant period of time?
I think, relatively speaking, it's quite safe. The simple reason regarding the infrastructure MLPs, they are fee-based. They get paid for transporting, storing, and the various services related to those activities. In many cases, they have take-or-pay contracts with the major producers and users of oil and gas and their derivatives. And worst-case scenario is a worldwide depression, which would reduce modestly the throughput of the oil and gas and derivatives, but as I'm always fond of saying, we do like to put gas in our cars and turn on our television sets and heat and cool our houses, and until nirvana is reached and we no longer use fossil fuels, the necessity for these fossil fuels is so abundantly clear that we couldn't function in this country or any advanced country in the world for 2 seconds without their being where we want them, when we want them. So, brief answer, safe, number one. Number two, full expectations on the infrastructure end of distribution growth. And as we're fond of saying, this too shall pass.
Great, thank you, Len. And that actually, your point of making the point that the infrastructure MLPs, as Darren pointed to as well, the midstream MLPs really are a different business model. They've been growing distribution. Question came in. Midstream MLPs just finished their quarterly earnings, a lot of which were very strong, and a lot of MLPs increased their distributions. Why are unit prices acting the way they are? Jim, do you mind taking it?
Well, sure. I think there are a couple of reasons. One, I think there's the concern of perhaps rising interest rates, although the Fed notes just came out, and I don't think we're going to see that a hike in interest rates for the foreseeable future. But we've done quite a bit of work in this specific area. So when interest rates are going to rise, and they will at some point. I don't know whether it's going to be in the fourth quarter or the beginning of next year. I think the perception will be that this will be a negative for MLPs. But we've just concluded a study, which we will be publishing shortly, about rising interest rates and the effect that it has on MLPs, and I think the findings were what we thought they were going to be, and there's really not a significant correlation. I think the second reason that the infrastructure MLPs have been affected in a negative way is that there's a misconception. As Darren pointed out, the infrastructure MLP business model is different from the upstream E&P model, and but it's still the infrastructure model is being tarred with the brush that if it's lower energy prices, lower oil and gas, then this is going to significantly harm the infrastructure MLPs. And again, this is not the case. In the short run, psychologically, yes, this is what has happened, but we feel quite confident that in the long run, for reasons that Lenny just discussed, we don't believe that this is going to have an adverse effect on the performance of the infrastructure MLPs.
No, you make a great point, Jim, and actually one of the other questions that you really addressed it, but is why are MLPs so misunderstood by mainstream media? And I think you addressed it. It's a lack of knowledge. It's a lack of understanding that the companies have different fundamentals and that the sectors have different fundamentals within the asset class. I think that's a really great point. Moving on to another question, Darren, if maybe you could take a stab at this one. How has the influx of MLP funds over the past few years, do you think it's had any impact on what we've seen recently and how drastic the sell-off has been?
Really interesting question. I generally speaking, institutional money is good because institutional money understands the asset class and brings stability overall to it. It has a longer-term horizon and is more patient money when it comes, or more patient investors. So I would say that the more we see fund inflows into the MLP asset class, the more institutional investors that come in, probably the better, and that would be more long-biased investors that aren't trying to trade around short-term market fluctuations and profit on those, but are really looking at fundamentals. So I think that is a long-term stabilizing force for the asset class and is good. So there has been some rumors recently that some of the younger funds that have come out, given the pullback, have had the equivalent of margin calls on them, that they've had to bring down debt levels in the funds. That's caused some selling. Personally, I don't think it accounts for enough of the overall volatility in the asset class. I think there's been more, again, speculation, but more short selling, more index-based pressure on MLPs in general, and you can see that on some of the big down days. Everything's moving down together, which is indicative of index-based shorts on the industry. Jim?
I think just one other point about the institutional ownership as funds flow to the institutions and they put the money to work into MLPs. This should help the price of the MLPs go up a bit, and it will lower their cost of capital. So I think that overall, I think that the institutional ownership, all things being considered, is generally considered a plus for the industry.
Sure, sure. Another question here. If oil was to remain at, say, $40 where we are now, potentially even lower for an extended period of time, maybe a couple years out, how would that impact MLPs, and would it have any kind of effect even on the midstream MLPs?
Well, I think that as I discussed before, I think that what's happened here is that with the price of oil having come down, the producers have become a lot more efficient. But again, remember the model that we're dealing with here, and that is the midstream, i.e. infrastructure model. And on the margins with the gatherers and processors, let us say, in other words, the ones that are closer to the wellhead, you can have some problems. But overall, if you stick with the high-quality infrastructure names, I think even with the oil remaining, let's say, at $40 to $50 a barrel, and that's not something that we estimate, but I'm just throwing that number out, I think the returns are still going to be very, very attractive. I mean, the current yield right now is very attractive, and we still think that, based on the work we've done, we're going to see overall perhaps 5 to 7% increase in distributions. The MLPs that we're investing in, because we've done our work, we're going to see distribution increases significantly above that 5 to 7% industry increase.
I think what is missing here in a lot of investors thinking of the asset class is that the U.S. is a mid-tier cost producer right now on a global basis. And we've seen as oil prices have come down, the offshore drillers are more expensive, and they've been really shut down to a large extent, or at least new projects. And what's happening in the United States is the equivalent of Moore's Law to computing power, which stated that computing power would I forget exactly what it was, but would double over time and price would come down in an equivalent fashion. So you're really exponential cost per unit of computing power. What's happening in the U.S. is that due to the profit incentive, E&P companies are incentivized to innovate, and that innovation led to the profitable production coming out of shale plays. A few years ago, in the mid-2008, we started to produce out of shale plays in a small way, and to where we are today. What's happened over the past 12 months, drilling costs have come down roughly 50%. So a tremendous decrease in the cost of capital in order to drill wells. Number one, your costs are coming down. Number two, our technology is improving in the United States in pulling more of the resource out of these unconventional shale plays. So currently the recovery rates are roughly 10% in that range for horizontal drilling or shale plays. When you look at conventional vertical drilling, you're bringing 80 to 90% of your resource out of the ground. So the more that we're able to recover from shale plays over time due to this Moore's Law, this technology increase, the cheaper we're going to get. So the U.S. is a mid-tier producer globally right now, moving towards a low-cost producer. So not only will we be the largest energy-producing nation in our lifetimes, we will also be arguably and conceivably the cheapest energy-producing nation, which means even if oil remains at a lower rate for a longer period of time, U.S. producers ultimately are going to be very profitable if these trends continue, price coming down for drilling and recovery rates going up in unconventional shale plays.
And as you mentioned earlier, Darren, the MLP business model is different. It's going to be about volumes, not about whether oil is at a sustained lower price environment. I mean, you even look at the Bakken right now where, 80% is still being taken out on rail. There are pipelines that need to be built in this country. Jim, or actually Len, if you could try this question. If you wouldn't mind just discussing, and I know that we're a little bit beyond this now, but if you wouldn't mind just discussing Rich Kinder's decision to roll up the complex into KMI, and has it worked, and do we see it as a trend going forward?
Well, he did it because he had to do it, because given the structure of Kinder Morgan Energy Partners, his cost of borrowing was very, very high, number one. Number two, the dilution for issuing equity was enormous. And it limited him severely in what he could add to his empire. By eliminating Kinder Morgan Energy Partners in the roll-up, he created a corporation which has lost carry-forwards for quite a while, shielding the dividend. It's now a dividend taxable at 20 to 23.8%, number one. Number two, he has promised he will increase that dividend over the next 5 years by 10% or more a year. And he has always under-promised and over-performed in his entire history since 1997. And I think, as we're beginning to see with Energy Transfer and some of the others trying to take over Mark West and Williams, we're going to see much, much more mergers and acquisitions, and Kinder is not going to be sitting idly by with this huge financial capacity to add to the empire. So he had to do this, number one, because he was not able to make any massive purchases, which, to use Buffett's great expression, would move the needle. And he's in a position to do that now.
Thank you. I think your point about them having to do it really relates to the IDRs that had accumulated at KMP and the cost of capital, and that really plays into a bigger question here, which is really important to address. Given the sell-off that we've seen and the yields that you mentioned, Darren, now in the 7% range, how much will higher yields on these MLPs affect future distribution growth, in the sense that they now have a higher cost of capital, a higher hurdle rate, if you will, on projects?
Well, you're still seeing. Let me just go back to 2008 and 2009, and even at the depths of the recession and when the capital markets really seized up, you still had the really high quality MLPs, in other words, Enterprise Products, EPD, and Kinder Morgan, which Lenny was just talking about, KMP. They were able to raise both debt, admittedly at a pretty steep price, but not outrageously high. And I think it was back in February, there were some unit offerings. So even at the bottom of the market, the MLPs were managed to raise money and to fund expansion plans. So I don't think that this is going to be a problem. Now, let's to talk specifically about one company, and that is ONEOK, which is yielding has a pretty fancy yield here. They're finding creative ways, and OKS, which is the partnership, recently, I think it was something like 24 million units that they sold, 21 million of which went to the GP, OKE, and the other 3 million went to a mutual fund, Kane Anderson. So if you have a strong GP, this is another way that MLPs are going to be able to raise money. So as I said, going back several years ago when things were really awful, MLPs managed to raise money. the question about whether or not this is going to raise the cost of capital, yeah, at the margin, it will. If you have the price of the units down, it's going to cost you a bit more. But the people that are running these MLPs, get out their computers and figure things out, and if it makes sense, they'll find a way to, to raise the capital to finance the either A, an acquisition, or B, organic growth.
I would like to add one other thing. In almost all of these MLPs, there is huge insider ownership by people who have been in the business for decades. And I doubt that they're in the business of trying to shoot themselves in the foot.
Good point.
Exactly right.
Just one other comment here is that if you look at the cost of capital, we're looking at the cost of equity, number one, and that's going up across the board for all partnership and partnerships. So we're seeing the M&A activity, which is still, it's the relative strength of your currency, will determine whether an acquisition is accretive or not, and then how it's financed with debt to equity. And if you look at the debt markets in MLPs where there's public debt, you'll see that they're really trading at par right now. There's not a lot of stress on the infrastructure MLPs debt. So the cost of debt is part of the overall capital structure really hasn't increased for MLPs right now. So when you're looking at it, you can look at equity, which is a good indication is the current yield. If an acquisition is accretive, if it's all equity, if you're buying one with a higher yield than yours, it'll be accretive to your yield and ultimately to your growth going forward. So it's a relative game, and then there's private companies out there, and there will be some stress coming up in the fourth quarter into the first quarter of next year from borrowing-based redetermination. So we think we'll see some distressed asset sales outside the MLP space, which will give MLPs an opportunity again to take advantage of weaker players and add their assets to their overall asset footprint. So there's just a lot of opportunities within the asset class right now, and you have to look at it not on an absolute basis alone, but on a relative basis where the opportunities for future growth are going to come from.
Sure, thank you. And just a question I can address here, can you talk about how you measure distribution growth, and what does your stability score of 10 really mean? We measure distribution growth as year over year, so it's simply taking the third quarter of 2015, looking at how that compared to the third quarter of 2014. And in terms of stability means that we have not, in fact, we haven't held any company that's cut its distribution going back through 2008, 2009. So that stability score of 10 is in fact 100% of our companies maintaining or increasing, in most cases increasing their distribution. So just to address that question. Jim, if you don't mind talking tax for just a moment, what are the chances that we see, I feel like we get this question almost every time, but what are the chances that we see any change in the tax policy that would take away the status of master limited partnerships as we have them today?
De minimis. There are several reasons why we feel pretty confident, or very confident, that we don't think that there's going to be a change in the tax laws that will adversely affect MLPs. First of all, if you go back a number of years, there were maybe, you had Texas and Oklahoma and Louisiana and Alaska and several other states that were oil and gas producers. In the last 10, 15 years or 10 years, because of what's happened with the shale revolution, you now have producers in Pennsylvania and other states, and each of these states has X amount of representatives, and each has two senators. So I think it's quite unlikely that you would get a bill through at a committee, let alone through the House and the Senate, that would change the laws, would change the attractive tax features that MLPs enjoy. The second thing is that really there's not all of that much money in the total scheme of things. It changes a bit, but I think that if the tax advantage were taken away or reduced, it would add something like $3 or $4 or $5 billion that would flow to Washington, D.C. So, again, we're not talking about large sums of money, and it would, I mean, this is one piece of legislation that was passed back in 1986 and then it amended in 1987 where the government got things right. It did this, when I say it, I'm talking about the advantage that MLPs have. It did it in order to encourage investment in the infrastructure of the United States, and it's worked in spades. I mean, look what it's done. We have an extraordinarily efficient energy infrastructure in this country, where the pipelines are, and the storage facilities, and the processing plants, et cetera. So the legislation worked. It wouldn't raise much money, and I think from just a practical political standpoint, I think it would be extremely difficult to get through Congress.
So then, let me ask, Darren, with that legislative, and thank you, Jim, very informative. With that legislative risk taking off the table, what should investors be looking at, saying, what's my biggest risk going forward investing in MLPs? How do I get comfort with that?
So the biggest risk then in MLPs would become, because the business model, let's go back to the business model. The business model is a pass-through model that income or cash flow is not taxed. So MLPs distribute the majority of their income. They don't have to, but they distribute the majority of their income, which elevates the yield and makes it an attractive income-producing asset class. Because MLPs aren't retaining earnings, which means holding back cash flow, in order to fund future growth, buying new assets, building new assets, they need to, using a Wall Street expression, tap the capital markets, which means they need to go to the capital markets and they either need to issue new equity or issue new debt in order to fuel future growth rates. So future acquisitions, buying or building, two choices. And if the capital markets completely shut off to MLPs, and MLPs were unable to go in and to borrow to finance new acquisitions or to issue new debt to do new acquisitions, that would be a big risk to the asset class for future growth.
Okay, great. Then to kind of turn things on its head a little bit, what do you guys see as the most bullish driving force of MLPs for the next 5 to 10 years?
Well, I think in the very, very short run, and again, this is purely psychological, and it really isn't a fundamental driver, would be the price of oil going back up. But I don't want to contradict what I just said about 5 minutes ago, but it would be, if you're looking for a trade, and we're not traders and we're not suggesting that you buy MLPs to trade, it's a fool's game. But I just think that the fact that the United States is a growing economy, and any modern, and efficient, and productive economy needs energy. And even if alternatives start to become more efficient and productive, there's nothing that can't stop alternative sources of energy, whether it's solar, wind, or biomass. I think there's a law now, or a bill, I should say, that is rattling around Congress. It's been there for a couple of years, but I think eventually it's going to pass, called the Parity Act, and that's going to permit biomass and solar and wind and all those, all the alternatives to form MLPs. So there's not going to be anything that's going to replace fossil fuels. There might be something that will add to fossil fuels, and that I think will be addressed once the Parity Act becomes law. So if you have a growing economy, which we do have, I wish it would grow faster, but that's for another discussion. And There are new fields that are being discovered, and the Bakken field, no one heard of it 2 or 3 years ago. There are demographic moves, people moving, from one area to the other area, and you need to, service these people as far as providing energy needs for them. So there are going to be capital projects, and the MLPs are going to be there to, provide the energy to provide to the utilities, and in order to provide, as Lenny earlier discussed, the air conditioning and heating and so on that we're so used to.
Yeah, that's great. And one point I would just add that I think it's lost in the shuffle when people see oil and MLPs trading in the same direction. They think they're so interrelated. Is the natural gas story that's going on in the country. We have the first LNG exports coming on in the first quarter of next year if all goes according to plan. We also have exports to Mexico that are continue to ramp on the natural gas space. And we also have, if any of you are in the Northeast, if you recall the prices to heat your homes in the cold winters here, we need more natural gas infrastructure built out in the Northeast, especially to urban hubs. So I think the natural gas story is probably going to be a driving force.
And also, I might add, Will, that the export of LNG, which is what you were talking about. Also, I think that we're going to become more enlightened in Washington. Already, we're talking about doing oil swaps with Mexico. Mexico has heavy oil, which goes to our refineries. That's the way they were built to refine heavy oil. And we're going to be swapping our lighter oil to Mexico, and I think this is a harbinger of things to come, where you're going to find, hopefully, it isn't just going to be natural gas via LNG that's going to be exported, but in time, I think people will understand that exporting crude from the United States is a good thing for a number of reasons, which we can get into if you'd like.
What do I find that is the most attractive over the next 5 or 10 years is the U.S. energy revolution. It underpins this. If you look at, on a global basis, again, over the last 3 years, prior to 2015, there was 3 million barrels of increased oil production on a global basis. All 3 million barrels of increased oil production came out of the United States. We are, from the 1980s through the mid-2000s, the United States was on a declining production curve, and MLP still grew their distributions. The production curve of oil and natural gas, which the natural gas revolution is even bigger than the oil revolution, although we focus on oil. We should be doing so much more internally to create more demand for nat gas. But even without that, we've turned positive. We're producing oil at 40-year highs. Again, we're producing 9.4 million roughly. If you look at estimates, the U.S. is going to be producing 16 million barrels at its peak. And could it be higher than that? Yes, it could be. If production recovery rates increase as they are across the shale play. So there is an energy revolution going on here. It's an energy revolution that has shifted the balance of power on a global basis. It's an energy revolution that's essentially taken OPEC down right now. So if you don't believe in the energy revolution that is centered here in the United States, you're missing just the biggest macro play behind this. This energy revolution hitting these production numbers. Again, we're a mid-cost producer moving towards a low-cost producer. Arguably, we may become the lowest-cost producer in the world. Again, we're going to need almost $1 trillion of estimated infrastructure investment into $500 billion asset class right now, with another $1 trillion coming in. That $1 trillion is, as Jim has said, historically that's the holy grail. That's the highest IRRs that MLPs can own by building, and it's going to come in. So we see MLPs being $1 trillion asset class here in the not too distant future, doubling the size of where they are today. That's what's going to fuel distribution growth. That's really when I look past everything is why I'm really excited. The United States is the best energy investment on a global basis. It's
really a tremendous growth story. Unfortunately, we're just pulling up into an hour here on the call, so there are certainly some outstanding questions which we will do our best to address either via email or phone number, depending what you left with us. If you'd like, you're always welcome. All of our listeners are welcome to feel free to to email in to us any questions or to give us a call at
212-755-1970.
Apologies there. As a reminder, a replay of the webinar will be available in the coming days on our website. We should have it posted within a day or two here at www.yorkvillecapital.com. We'd also like to remind the audience, as Jim mentioned earlier, that we will be releasing a comprehensive white paper on MLPs and interest rates in early September, so please keep an eye out for that. We look forward to speaking with you in a quarter's time, and thank you, everyone, for your time.